Hello and welcome. You're watching Business Day. This is Aastha Chopra. Well, today we are joined here by very special gentlemen with us. Thank you so much, gentlemen. We have Ashish, Shankar, the MD CEO of Motilal Oswal Private Wealth, and we have Sandipan Roy, who is the CIO of the same. Thank you so much. First of all, very informative outlook you have given us. Let's take the conversation around the investor-centric today. We always talk about companies. Let's say what will be the good news for the investors in coming 2026. So briefly, can you tell me how will be the year for the retail investors? Because I am finding that they are confused between optimism and caution. So how will it reflect for the retail investor? We'll start with you, Ashish.
So I believe we are entering this year on a more positive note. Reason being that we've seen equities consolidate for 15 months. And whilst we are speaking, there's already a solution to the impasse on the US trade deal. We've signed a trade deal with EU. So valuations are pretty supportive. Sentiment is getting better. And even the earnings outlook for the next couple of years is looking pretty good. So actually, it's a good backdrop. Whilst I understand that most people are driven by past returns. So when someone looks at their portfolio, last 2 years has not done much. Or maybe in certain cases, the portfolio is down. However, I just wanted to reiterate to all the investors out there to keep the faith. Things are looking much better now, and they should continue with their investments. And I think we've seen a lot of flows into Indian equity markets from retail investors through SIP route. And I just wanted to give them confidence that SIP is the best way to create wealth. And you should continue with your allocations. And on any sharp falls, on any day where there's a sharp fall, you could add more to your equity portfolio.
Absolutely. You want to add something, Sandeep?
Yeah. So yeah, as Ashish said, on the equity side, I think SIPs are your best friends because when there is correction in the market, I think it's even better for SIP investments. And which is where both time correction and price correction makes your SIPs even more attractive. You should continue doing them. But not just for equity investors. This year, I think it will be continuing. I think it will be a much better news even for debt investors. Because the yields have, on the let's say on the duration side, the government, G-Secs, etc., the yields have hardened. And I think they are at very, very attractive valuations now. So positions there as a fixed income investor, I think will give you a good return in this next 1 year. Okay. Similarly, if you are in commodities, everybody wanted a correction in gold. Everybody wanted a correction in silver. When they happened, I'm sure at least some people participated. Okay, so there will be such entry points coming throughout the year, and hence you need to be there, be a bit more vigilant, and as and when your levels are getting touched, don't be afraid to buy them.
Okay, so I've addressed the elephant in the room. Like recently, we have all unexpectedly it all went down. So what do you let's deep dive into that topic. People or investors here are typically confused when it is coming for commodities, especially silver and gold. So what do you think? Like they should go in all for it, or we should wait it out, or what do they do?
No, so on gold, I think the fundamentals are very strong. They continue to remain strong. As our base case is that, gold is driven by geopolitical tensions, by de-dollarization or debasement of currencies. And of course, the entire, I would say, the demand from central banks, right? So there, the core hypothesis remains that central banks or the loss of faith in currencies and central banks. So long that continues, and which continues, I'm sure, for globally, I think gold will continue to do well. Obviously, any asset class that has a very sharp uptick goes through a period of consolidation. Nothing to despair. Okay, you just have to be a bit more patient, but actually that gives you better entry points, right? And on silver, I think the speculative rise has been too much, which is why the drawdown was also very sharp, much sharper than in gold. But there has been a retracement also. So it's just a nice chart that's forming, and which actually we could also predict in a way, because it was so I think it was very predictable, the chart itself. So silver, on the other hand, I would say that you should stagger it over the next 3-4 months. Silver always gives you entry points. It's far more volatile. It's actually double the volatility of gold, even on mathematical terms. So silver, I think it's better to stagger it over a 4-month period. You will get your entry points. Okay. And gold, if you are under allocated, please put money in gold today. If you are overweight, let's say in silver, some of us have been lucky to be in the silver rally. I think you can take some money off the table then. So I'll be neutral silver. I'll be slightly more positive gold.
Okay, well, that's very good explanation for investors as well. Coming back to you, Ashish, let's talk about the fixed income. Like with possible rate cuts ahead, what do you see the best opportunity for salaried investors? Where should they, which sectors should they go ahead with? Which sectors should be the red flag for them? Can you tell us?
Right. So two things here. See, the two components of fixed income. One is obviously the rate cut, which makes headlines, whether RBI has cut rates. The second is transmission. When I say transmission, is our banking system flush with liquidity or negative on liquidity? Because if you're flush with liquidity, rates will automatically come down because supply of money is more than demand of money. So for the first time, after this US trade deal has been announced, we are seeing currency appreciating in India. That's a big relief for RBI. Now I believe that RBI can also aid transmission better, which means they can make the system surplus liquidity. So what does that mean? Interest rates for a lot of borrowers will come off. Similarly for banks, they will be able to see the cost of money decreases and it has a positive effect on demand. So I see credit demand also picking up. So clearly financials comes up as a sector which should definitely do well. But from a more longer term theme point of view, see, India will slowly turn from a nation of borrowers to savers to investors. We are seeing more and more investors coming into the fold of mutual funds. As this happens, capital market players will also do extremely well. So in the near term, medium term, I think banks, financiers will gain and they will benefit and they'll do well. And these stocks are also priced not very expensively. And again, within that, I think PSUs have an edge. Their ability to raise deposits is clearly superior to a lot of their private peer group players. However, the longer term theme is capital markets. So whether it is people who are exchanges or platforms, whether it is the infrastructure players like custodians, and of course the people who are into the main capital market businesses like wealth management, asset management, so on and so forth.
Absolutely. So I would just take a more clarity on that if you want to add something on that, or plus you can just tell us the typical portfolio should ideally look like what ratios can be there in equity, fixed income, gold, on real estate today, like if you can explain it.
No, so for a retail investor, right? So there, anyways, real estate will be the largest part of the portfolio, not by design, but because you are forced to. Real estate is the biggest investment that you make as a retail individual, right? So I'm taking real estate out. Hence, in the financial assets portfolio, I would say that be neutral. As Ashish was also saying, that this is a year where you become far more neutral. Maybe slightly inch towards equity, which will be a larger allocation. There, don't have a cap bias. I think it's best to be in a flexi cap fund. Okay, play across the curve because opportunities are across the curve. It is more bottom up. I think it will be more an earnings growth story, which will be more bottom up stocks driven. And hence, don't be biased that large cap is safe or small cap is very risky. Without getting into that, I think it's best to be in a flexi cap fund. So have a flexi cap allocation for equity. If you're a balanced investor, let's say assume it's 60% should be equity. I think you can tend towards 65%. But, obviously with some bit of staggered investments, but largely, at least 50%, if you have 100 rupees today, 50% you should put today, and the rest 15% you can stagger over the next 3 months is how I see it, right? On the debt side, again, it's a balance between some bit of duration, but duration will be a bit more volatile. But as I said, it's kind of steepened, and hence some money in long duration fund, but largely play an accrual, which you can do through through a bond, etc. And be in gold. Silver can be staggered. Also a new asset class which has come. If you want yields, I think a fabulous asset class is REITs and InvITs. Especially if you are expecting higher yield, I think move into InvITs. There are some really good InvIT options in the market. You should replace your accrual debt mutual fund with InvITs.
Okay. Okay, got it. Understood. So we'll just finish up this conversation with one open-ended question. It's for both of you. What will be the growth strategies of Motilal Oswal Private Wealth in 2026? We'll start with you or you anyone.
Right. See, the growth drivers for this business are pretty simple. We are investing in 3 areas. One is in adding high quality talent. So we are recruiting private bankers across the country. In all segments, whether it is HNI, affluent, or ultra HNI segments. And due to the kind of brand and the platform that we've created, our ability to attract talent keeps improving year on year. So basically, you want to have a talent advantage in the market. Point number 2, we are continuing to invest in capabilities on the platform. So I just spoke about the kind of team that we've created. I mean, Sandipan obviously leads the investment team. Under him, we have created significant capabilities across equities, fixed income, alternatives, private markets, family office, real estate. So essentially, we want to have a platform advantage, massive platform advantage. And lastly, but not the least, we also continue to invest aggressively in client experience. So these are 3 areas where we will continue investing, and this I think will create a natural advantage for us from a business point of view.
Absolutely. You mentioned some closing comments on that?
I think Ashish already summed it up well. I think the other part is Motilal has an advantage of being a leader across all the business verticals that it operates in. The other key focus area would be to have really large group synergies. So it's a I would say it's a wealth management outfit which is full stack. That's the endeavor where we are catering to all the needs of clients, be it on deployment for investment purpose or raising capital for your growth purpose. Right, so we want to be present across all the all the needs of the clients, even non-financial needs. A large amount of focus and team building is also going towards building the capabilities on the value-added services. You have your investment needs, but beyond that, you have business needs, where, as I said, the group synergy comes into play, and then you have your family needs. Okay, and there it can be and simple trust or an estate planning or a will kind of a planning or a structure, to even more complex, even your philanthropic needs. That's the other area that we'll be focusing on as well.
Absolutely. Thank you so much for the lovely, wonderful insights. This conversation was typically for the investment people and retail investors who are watching this. You've broken down all pieces very accurately. Thank you so much, gentlemen, for speaking to us. And thank you so much for coming on BTTV.
Thanks a lot.
If you like the video, do like, comment, share and subscribe.